Hi folks, Scott here, and this is the wrap for Monday, November 25th. I can't believe November is almost over, but I am back from rainy Las Vegas, Nevada. Yes, I did say rainy. Very unusual rain the whole time I was there, but fortunately or unfortunately, I was inside just about the whole time at the Las Vegas Money Show Traders Expo, which was a good event, pretty good event this year. So let's see. So here's what happened today. You could probably see here without me zooming in, but I'll zoom in briefly. New high, that's a 200-day high, but we did not close at a 200-day high close. Closed down a little bit today relative to Friday. So 200-day high, but not a 200-day high close. And a red candlestick. So I just ran this test to see what happens when fading gaps after such a unique pattern. And the sample size was a little bit too small, so I loosened it up. And I'm going to show you the results of fading gaps after a 50-day high, but not a 50-day high close, and that regardless of whether it was a red or green candlestick. So 50-day high, not a 50-day high close. And I will tell you, this is not what I expected to see. There you go. Odds favor a gap up. That's not real surprising to me, but I would have guessed, maybe even bet, if I had to bet, that odds would have favored the short side in such a scenario, thinking that today's bearish candle would be indicative of potentially bearish follow through the next day. This doesn't show that. Now, in fact, it shows odds of gapping up, definitely favor almost a 50% greater chance of gapping up than down. And this sample size is a bit small to overreact to, but I ran it several different ways, and they were all showing consistently longs were the better trade using an end of day stop, and shorts were riskier. Now I think it's because you've got this one big loser right here, but even the longs over here have a big loser. So I'd say there is a slight long bias after such a pattern, but I will tell you it completely goes in the face of what my experience is telling me here. So we'll see. Trust the data. That's why I run the data like this. I don't care about my gut nearly as much as I do the data. It's the data that keeps me out of trouble. So I'm going to keep this in mind. It might be, if anything, it's more neutral than you might have expected. That's the way I'm going to head into tomorrow. And as always, I have to refer to our gap guides before I make my final decision, and our TGP worksheet, today's gap play worksheet. And I'll rerun these numbers using our MTG stop parameters just to confirm how tradable a down gap may be, and what this data looks like here when you apply an MTG stop. All right, let's look at what we had going into today. This is the data that's showing on the website over the weekend. I'll go to the worksheet first. This is where I always start my analysis. It's just a summary of the individual guides. So at a glance, I can get my head into the game, and I knew that gaps opening above the prior highs met my criteria barely. Win rate minimum of 60%, check. Profit factor criteria minimum 1.3, and those are ideal minimums, I should say. They're not rock solid. They're not so fixed that I wouldn't vary if this was 1.27, for example. But basically, right at my criteria. So, yeah, I'm going to have to trade this with some type of a position. And no unique day factors or patterns to worry about shown there. On the guides, however, and I'll just show you the individual guides, the ones that are averaged up to make those numbers. We just averaged all these numbers in the weighted average, and you can see the UH zone looked good today for the ES, neutral in the YM, slightly attractive, just narrowly missing my criteria in the NASDAQ, slightly attractive in the Russell, same. Looking at the ETFs, yes, I'm going fast, but you can go back on your own, look at this. Spider confirmed what the ES showed. Diamonds slightly attractive, NASDAQ slightly attractive. Russell looked good. So only 3 of the 8 technically met my criteria, though the average overall did meet my criteria. So I'm going to trade it, especially when the Spider and the ES were both confirming the trade. Some unique patterns that I stumbled on, up gaps in November that I showed in the weekend wrap. 6 of 16, so today is a winner. It's tough to trade in spite of numbers like this. You just got to remember that there are many cross currents in play on a given day. And this one, as I suspected might, would be overwhelmed, and it was. Sizable up gaps in the UH zone on Monday, historically during bullish markets, also problematic, but that too I had to discount. Sizable up gaps on Monday after a 50-day high close went above the 200. Check that out. So when you're really stretched, anything but a very stretched situation would have made today's gaps much more risky. That's what I realized when I interpreted the data. Here's what I posted. Slightly attractive historical odds. The unique day and pattern data from the worksheet. and above. Someone asked me, but they missed that. And above, always the second sentence or paragraph is always the averaging everything that's shown here and on the worksheet that I showed you previously. Show mixed factors overall. So I said a faded up gap against a half size position. Use a slightly larger stop of 6 points to show them above the weekly R1 level. We'll use delayed entry if needed to get filled greater than or equal to 1805.5 so that I could use no more than a 6-point stop and be above that level. That's what I meant there. And that's what I did. Always do what I'm going to say I'm going to do. To the greatest accuracy possible. And markets open 1806.25. I was filled short at 1806 in the ES. Now, one thing I hadn't completely thought through until I got into the room, and I processed this very quickly in the trading room and told them within a minute or two, I posted it in our announcement tab, that's one of the benefits of being in the trading room, was that the 4 p.m. close, which you should track, it's in the tips that I share on our website, was 4 p.m. close, 1802.75. So that was up here another 1.5. So I scaled out because the market's been so bullish and the highs, even during this incredibly bull market, have been prone to being tested. And then you've had reversals off the highs, unbelievably in some cases, where you continued higher. Just not taking that chance. Odds weren't quite strong enough for me on the gap guides for me to get as excited and traded aggressively. So I scaled at half at +3. That was my first target. Second half was 1801.50. Now the extended target was favored here on the worksheet. One of our longtime members, he's in the member spotlight. Where's the member spotlight? I thought we had that up here. Go to the home page. Let me see if I can find it before I say this. Matt Bowe. Where's Matt? Matt from Missouri, right there. Matt's a longtime member, been with us 4+ years. Very good experienced member, trading just the probabilities, guiding his decisions. He went for his entire position at the extended target today because the data was good, and that's what his plan said to do. See, this met 80%. Often I'll do the same on the stronger setups. I just wasn't as confident on that. In fact, that's why I went for T1, which is a little bit that more conservative first target. So I did trade this very conservatively. Matt went aggressively, got 6.5 points. Took him all day. Right, he had to wait till he got over here. So good for you, Matt. Big shout out to you, and many thanks I know go to you from other members as well who took your lead and not just mine. So good trading. Now I do want to say one thing. So I got out for my first target was set for +3, and then I used my proximity rule trigger down here because we were within 2 ticks or 3 ticks of my target. So proximity rule triggered. I tightened my stop to just above that wick, and I was taken out at 1804.50 for +1.5, an average of +2.25 points on a 4.5 point opportunity. A little disappointing, to be honest, but I followed my plan. Now, I want to be clear. I trade my core account extremely conservatively. My goal is to have the smallest drawdowns and the most steady returns. If you overmanage your positions and you trade too conservatively, you won't get the nice wins like Matt had today. And you could argue maybe I should have had today because the data was good. But I intentionally trade my core account conservatively. And you got to remember also, I am doing portfolio level management with my core account considered, meaning I was in this position in every other account I had. I am not able to manage these other accounts. Some are mechanical, some are discretionary. Well, technically I can manage those, but frankly I generally don't. The smaller, more aggressive accounts. So I caught the full gap fill on the entire position today for 4.5 points because I just left it alone, and that's what my plan says to do on those other accounts. So I'm pointing out, yes, trade management costs you. There are some benefits as well. But the key thing for me is if I were not in trading these other accounts as aggressively as I do, and they're now comprising a little bit more than half of all my capital, they've grown more aggressively actually than my core account, frankly, because I've been trading it conservatively. But I do have to consider what's going on with them as my trade management. So I am going to trade more conservatively if I'm holding others more aggressively, because I had exposure all day until after 3 o'clock today in these other accounts where I could have gotten stopped out and lost more. So keep that in mind. That's why I tell people to use me as a guide and use our data as a guide. Use your own money management, your own sound decision making to create your own plan that's appropriate for your targets, your risk, your financial objectives. All right. Have a good one, and we'll see you tomorrow. Take care.